good. So thank you very much. I appreciate being able to be on this morning, and I'll try to be fairly quick as we go through this. I've got enough to keep this going for an hour and a half, but I can cut it down to 5 minutes or 20 minutes. So this is a securities offering, and so the disclosure is we work with accredited investors only, and this is real estate. So, real estate has its unique risks, and we are in a particular class of real estate. So all of our offerings are sold by prospectus. You have to come through a financial advisor such as RJ, and we are very happy to be able to present to you this program and see if it might be suitable and appropriate for your needs. Go ahead and advance that slide.
Okay.
I'll try to. Okay, so a little bit about Exchange Right and TELOS, and maybe a little bit about me too. I actually was raised in San Diego. My family, I know RJ's out of San Diego, and my family came to San Diego, mother's side in the 1890s, father's side in the 1920s. And I left San Diego to go to school in the 70s, and came up to Los Angeles, and then found Pasadena as my home. So Exchange Right and our sister company, TELOS Capital, are both located in, headquartered in Pasadena. We are a vertically integrated real estate company. When you look at the map and you see all those orangish brown states, those are the states that we have properties in. We currently have actually about 700 properties in those states. The second bullet point there, multiple platforms. We are known for our 1031 programs and value-added funds and the essential income strategy, which we're going to talk about today, which is a REIT program. So folks come to us because we primarily work with pre-retirees and retirees, and we build our programs to suit their needs. We're not going to talk about TELOS today, but our real estate background is fairly broad. We're currently building RV parks in Texas. We're building senior housing in Iowa. We've built movie studios in Georgia. We've remodeled shopping centers. We do a lot of that sort of thing, but we also specialize in net lease portfolios, both acquiring, managing, and eventually divesting of them on behalf of our clients. We've got about 2.6, now it's probably 2.7 to 2.8 billion under management. And again, we're in 38 states. The next to the last bullet point is all of our offerings are meeting or exceeding the projections that we originally began with. And we have, I think we're on offering number 52. So that's pretty good. And as I say that, last bullet point is past performance is no guarantee of future results. However, even in light of COVID and in light of protests, we are 100% rent collections on 700 properties. We've never had a missed rent since our founding in 2012. Okay, would you advance? Thank you. So what do we strive to do with this program? Well, our investor needs are similar across all of our investors. Again, because we're working with a retiree and pre-retiree, capital preservation is key. So we broadly diversify in this portfolio with recession-resilient industries, and I'll also say Amazon-resilient industries. So we want to buy properties that are going to do well in a recession. As I say, even with COVID, when other companies have been collecting 55 to 85% of their rent, we're still at 100%. On stable income, we buy the type of tenants that pay their bills. So we use necessity-based credit tenants with long-term leases. So necessity-based is going to be companies like grocery, like a Kroger or Walgreens, CVS, auto parts companies like AutoZone, Advance Auto, O'Reilly's Auto, Napa Auto. We're going to have Tractor Supply. We're going to have certain banks, etc. The credit tenancy is critical. So a credit tenant is going to be an investment grade credit tenant, meaning they're in the triple Bs or above on the credit ratings. So you're not going to get us buying anything that is a quote unquote junk credit, the old term junk bonds. The default rate for a junk bond is very, very high, whereas credit-oriented bonds, you're going to have strong collections even in the worst of times. And so that's why we've been so successful in our collection efforts. We do only long-term leases as well. Long-term leases in this industry is 10 years or longer, and so our programs all have long-term leased properties in them. On tax deferral, this program is got both great depreciation referral benefits and the 199A deduction. So depreciation will give you generally about a 60% of your income will be deferred through depreciation. Sometimes it's even higher, like 70%. And then the 199A deduction, which came into law a couple of years ago, is an additional 20% of whatever the net income is. And that's a freebie. It's a giveaway. It's not recapturable down the road. So this program gives both the depreciation and the 199A deduction. And then very important is the strategic exit component. We believe that you can't go into a program unless you have a pretty good idea of how you're going to come out of the program. And so all along the road of our building this program, we have KPMG value the program every quarter. And ultimately, we will be taking the assets that have been acquired and we're going to take them to an aggregated exit where we will look at a sale, merger, public listing of our combined portfolio. And we're looking at that in roughly 4 to 5 years from now. And in the meantime, every quarter we have the portfolio revalued. And if our acquisitions will not result in an increase in value according to KPMG, then we don't make that acquisition. So we try to protect our investors in that regard. Let's go to the next slide. This is a summary of what the portfolio of our current assets and the identified properties that we are in the process of buying, what they look like combined. So let's just start on the top row to the left. The current cash flow is at 6.89% on what we call iShares. And iShares is what RJ and his firm have access to. Those are an investor class share. So there's a real benefit to using somebody like RJ, because if you come to us through some of the other channels that we come through, you're not buying iShares. So that's a real great benefit. So 6.89%. We'll talk about increases to that in a few more minutes. But the second item over is our what we call FFO yield. And that means funds from operations. What are we actually yielding from funds from operations, from the rent we collect minus the expenses? Right now, where does that fall? And we're actually generating at 8.72. So with that, the next item over, it means I'm at 128% of what I'm paying out. I've got room if COVID, has resurgences, and you do find that a tenant were to have trouble with paying rent for a month or a quarter, we are just, we're in really good shape to be able to sustain our dividend distribution and to increase it in the future. So that's an FFO coverage. It's pretty amazing, but we're very conservative the way that we project and what we do, and then again we back that up with KPMG looking over our shoulders. Then on that 10.24% premium, right now, if you were buying an iShare and you put in $100,000 or $1 million, you would have a $1 million investment that your first statement would come out at $1,100,000 because of that 10% premium. So I like to consider that a cushion. That's the valuation premium that KPMG says those shares are worth. I look at it as being a cushion. If something happens in the market and you came in with your $1 million or your $100,000, then you've got some cushion for if things were to go wrong in the general economy. So that applies to everybody that comes through on an iShare. The next column, what percentage of these companies that we are invested in? You can see the companies down below. We own the buildings that they are occupying, okay? So under that second column, it says 97.1% to the left there are essential businesses. Essential businesses, that would be the definition that where the government says, hey, you can keep this open because we need you even in light of a pandemic like this, right? So 97% of all the businesses that we own their buildings are they're essential businesses, meaning they remained open. In this particular portfolio, we do have a Ross Dress for Less in California that was required to close, and so it did close, and so that's one of our non-essential businesses. And now, of course, it's reopened again, but they paid their rent throughout, and none of my contractual agreements on rent with any of our tenants allow them to stop paying rent because of acts of God or because of a COVID pandemic. So they still are required to pay the rent, and because the balance sheets are solid, they can pay the rent. That same column, you see the 100%, that's the percentage that are national credit tenant or investment grade tenants. Our debt coverage ratio, we do use modest debt in this portfolio, and debt coverage ratio or debt service coverage ratio, you see there's 2.84 to 1. That means I'm collecting almost 3 times the amount of rent that I need to pay the mortgage on the various mortgages on these properties. I like to use a debt of no more than 50%, and I'm under 50% debt on this portfolio. And again, I've got almost 3 times the amount of rent coverage I need to pay the mortgage. So risk of me ever losing a property is inconsequential. Our weighted average lease term, you see the 10.6 years. That means the average remaining lease term on my leases to these tenants who are occupying our buildings is 10.6 years. So I've got guaranteed income. Now, do we guarantee the income exchange rate? No, we don't. But the underlying corporate tenants guarantee the income. And quite frankly, you'd rather have Walgreens guaranteeing your income than you'd want to have exchange rate, because Walgreens is doing the hundreds of billions of dollars of revenue. So our average lease term is 10.6 years. We have 111 properties that are designated into this portfolio. We're in 92 markets, 17 tenants, 10 industries, and this covers 24 states. When you look at the makeup there of our leading tenants, you'll find that, you know, Walgreens at about 16%, followed by Dollar General. We'll get into this tenant mix in just a minute, but Dollar General, and then Hy-Vee Grocery, which is a regional grocer out of Des Moines. And I have a affinity towards Des Moines in that we do have an office in Des Moines. It's our secondary office. And one of my partners is actually based out of Des Moines. And then Tractor Supply Company, which they're very popular in rural America with about 2,800 locations. Family Dollar, and then Kroger, CVS, BioLife Plasma Services, Fresenius, Advanced Auto, and then additional tenants beyond that that don't hit our top list. Let's go to the next slide, RJ. So the reason that we love these assets is because they do really well in a recessionary environment. So this is the last recession. So it's covering from first quarter of 2008 to the fourth quarter of 2010. And the lines, I'll describe them real quickly, but the top 2 lines, let's see, we can go back to that slide, RJ. But the top 2 lines there are necessity retail businesses. And we are the green line, and net lease retail overall is the orange line at the top. So you can see how steady, even in bad economic times, they were extremely consistent. The properties that we own were extremely consistent. The properties in general were extremely consistent. kind of interesting because we didn't have in the last recession, we didn't have the COVID where you had to close locations and you had other stress on mom and pop retailers this time that you didn't have last time. And comparatively, this time, the green line, our line with exchange rate, we haven't missed the rent payment, whereas the top line, the orange line, they've been seeing issues because the industry as a whole also has investments in assets that we won't buy, such as gyms, movie theaters, restaurants. I've never been willing to buy those because I feel they're a specialty asset unto themselves. And I didn't want to get into having to know that specialty, whereas the industry usually has about 15% of their assets in that type of assets. So we're consistently continuing to climb. Now, the other asset classes and the other lines you see there, the red line is multifamily. They took a hard beating in the last recession and took about 3 years to recover. The silver line is office. They actually never did fully recover. The blue line is other type of retail. So shopping centers, malls, that sort of retail has consistently had a hard time and then just got whacked again. But last recession, it took a long time for them to come back. And then industrial took about 5 to 6 years to come back, and then they did actually pretty well. So the point is, net lease does fairly well in bridging the gap, and again, that's why our 100% rent collection makes sense. So the next slide, RJ. The tenants, just to give you again a quick snapshot, but Walgreens, their 2019 revenue was $137 billion. They back the leases that we have of the Walgreens stores in the portfolio. Dollar General at about $28 billion. They're the largest of the dollar stores. Many Californians aren't that used to them because they were founded back in Tennessee, and they've been around. They've got tens of thousands of stores. I think they're at about 14,000 stores or something like that now. AutoZone, they're BBB rated as well, doing about $12 billion a year. Kroger, you've all heard of. Of course, they operate under a number of different brands. They were at $122 billion in sales. Tractor Supply, again, many have not heard of Tractor Supply if you're not in rural America, but they did over $8 billion last year. And then BioLife Plasma, which is a Baxalta company, BBB plus rated, $19 billion a year. Next slide. And then we get into some others. CVS is bigger than Walgreens at $250 billion. Hy-Vee Grocery is the regional out of Iowa that I mentioned, and we own stores throughout the Midwest region. Family Dollar is owned by a company called Dollar Tree, and together their annual revenue is in the mid 20 billions a year. And just a comment on a couple of these tenants: Family Dollar, Dollar General, CVS, Walgreens, Kroger. These stores all did very well during the recession. The ones that had struggled that we have in this portfolio during recession, they didn't struggle to pay their bills, but they struggled our auto parts, like you see on the screen, Advance Auto. When people aren't driving to work, they're not, they might be repairing their cars initially, but there's a point where they don't need the parts. And so Advance Auto as a company has done fine, and they remained open during the pandemic, but their sales were off. So we will see some of that where there's been differences in sales, but not differences in credit ratings. So again, this is just a snapshot. And then finally, this is the last page. I mentioned Dollar Tree that owns Family Dollar. We've got a Dollar Tree in here too. And Ross Dress for Less I mentioned. Another one's kind of interesting is Hobby Lobby. And we love Hobby Lobby's balance sheet. We own a few Hobby Lobbies, and this portfolio has one Hobby Lobby. Hobby Lobby, extremely strong financially. They have notoriety. It tends to be that the conservatives love them, and and many others don't like them because there was a Supreme Court case that they were involved in a few years ago. But from I buy them for financial reasons, that they are a solid company. So you will see a Hobby Lobby in this portfolio. Okay, let's go to the next slide. I mentioned about the valuation premium. We have a 10.24% current premium according to KPMG. So again, if you came in with your money, you're going to see a higher statement on your first statement. And then after we buy our identified properties, KPMG is saying as we add properties and get up to our full 111 properties, then the premium will rise to 10.64%, given that everything else is equal, which we know it won't be, but we are anticipating we're going to have a slight increase in our value of the shares. Let's go to the next. That just illustrates that. Let's go to the next slide. I'm sorry I'm racing through this, but I want to give plenty of time to RJ to follow up with his next idea. So exchange rate, the purchase price per share is $25 a share. That's the top line. The net asset value is currently at $27.56. That's where you get that 10.24 premium. And so it's 110.24%. Our peer group of how most of our peers are priced, usually when you're buying a REIT, you're buying at the net asset value, and you're covering some of costs of bringing this to market. We've intentionally structured our programs a bit different in that we don't take upfront fees for putting together the program, and we're motivated on the back end, where our belief is if we don't return the investors all their capital plus their cash flow plus a gain, then we shouldn't be receiving any kind of incentive. So our basic program is that our investors need to receive 100% of their capital, a 7% base return, and then everything over 7%, we can share in that, where we can get 20% of anything over 7, and you get 80% of anything over 7. So that's our basic structure. We can make a little bit of money up front if I buy assets and I have a seller. Let's say I've got someone selling their Walgreens or dollar stores, then we will be able to participate in half of that seller's commission that he's paying to his real estate broker for selling the property. So I inject my realty company in the middle of that, and so on a purchase, if it's paying 2% to his selling broker, then we're going to pick up half of that, or 1%, and that gives me some margin up front as I'm buying to be able to have some profit. Okay, so that's a little picture on asset valuation. We have been able to increase our dividends. We brought this fund out about March of last year, and we've had 3 dividend increases so far. And as you saw on a previous slide, it's because I've got enough room in the gross rent that we're collecting to be able to increase these dividends. So we've done 3 thus far. Next slide. And this is what they look like. We began this program at a 6.5% distribution, and then just a few months later, we increased it to 6.85. In March, we got our year-end results in, and we increased it to 6.87. And then in May, we approached our investors. We asked them if they would agree to expand the fund further. They did, and with that expansion, it gave us very comfortably the ability to increase the dividend again to 6.89. Although the past isn't a guarantee of the future, I do believe that we will see some other opportunities here in the future. On targeted yields, our targeted cash flow will go to the left side. We originally targeted 6.5 for last year. We ended up at 6.79 average. We originally targeted that 8.93%, that dark green bar. We targeted the tax equivalent yield to be a 8.93. We actually delivered a tax equivalent yield of 11.7 for an investor that would be in a 37% tax bracket for federal, 8% for state, and subject to the Medicare surcharge tax or the investment income tax. So maximum, you know, it would have been equivalent to getting 11 point, or needing to earn 11.7 if you were earning it in interest and having to pay tax on it. For year 2, we're currently at that 6.89%, and we believe that'll turn out to be about 11.03 tax equivalent yield. Those tax equivalent yields, of course, they drop if you're in a tax-free state because you don't have to pay that state tax of 8%, if that was 8%. But you can kind of see where we believe we're taking the fund both on cash flow and tax equivalent yields. And you'll want to consult with your tax advisor as to your particular situation, but it's a very nice tax sheltered yield. So our current dividend coverage, I've already alluded to this, but our FFO yield, our funds from operation yield, is actually about 8.72. That's the money we would have available to pay out. We are paying a dividend of 6.89, and our dividend coverage ratio then is now 126.5%. Our competitors, you can see what their FFO yields are. Most of them are quite a bit lower and probably going lower still because of COVID. The gross dividends, sometimes they're paying out, you know, more than they're actually earning. And so you have to be really careful with that. When you see over to the right side, you see some of these funds where they're actually, you know, not covering their full dividend, but they're still paying their full dividend. That means they're really just returning your capital. So we're not returning your capital. We're returning to you earnings on your capital, and anything we're not paying, it's still yours, and it's going to come to you at the end of the day as we exit. You know, so those that are in the red, it just means that they're only making 46% of what they're paying, or they're only making 67% of what they're paying. So we're in a really healthy position there. So aggregation and exit, and I'm going to kind of end on this concept, but combined, my company's currently, I'm managing it's actually about 2.7 billion, and we're adding about 600 to 800 million a year to that. And so, you know, over the next 3 years, I'm going to be pretty easily between 4 and 5 billion and maybe higher in total assets under management. And this REIT is part of those total assets. But by having this much in net lease assets, and now these are only the net lease assets. These don't include what I'm doing on, you know, building senior housing or building RV, doing that sort of thing. It doesn't include that. This is just the net lease portfolios. And I say that because you can easily aggregate homogeneous assets. You know, these things are, no matter whether you're in a 1031 portfolio with us or you're in this essential income REIT with us, all of these assets are very similar. They're the same basic tenants. We have a pool of about 60 tenants that are of the right credit quality, the right lease length, the right locations, the right industries that we would buy from. And those are fairly easily aggregated. And so by aggregating them, again, in about 4 years to 5 years, we're going to be able to then look at a sale, merger, public listing, or an IPO. And we are looking for generating a premium to the current values by doing that. So another slide, RJ. So in summary, when you look at the exchange rate as a whole, you'll end up finding us with over 2.6 billion of assets. We're at about 99% investment grade. We're over 99% investment grade tenants or national credit tenants, 93% from essential businesses. Average lease length in the whole portfolio is 10.9 years. We're 100% leased. We don't have any assets that aren't leased. We're in 447 markets, et cetera. and that's the basic makeup. So I think with that covers the basics of the fund. We would love to have you in as an investor. Our investment sizes, we're very comfortable with pretty much any size investment, other than if you want more than 9.99% of our total. That's where we cap out. We'll allow someone to have up to 9.99%. So that gives you quite a few $1 million that you're able to buy in with us if you're interested in it. This program is appropriate for qualified plans. A qualified plan would be your IRA plan or your private pension plans that you might manage. They're appropriate for that. They do not generate UBTI, unrelated business taxable income. And they're suitable for cash investors that are trying to look for a place to put their assets that will give them a decent yield. And this cash flow does pay monthly. From a liquidation and what are your options there, we do have, after you've been in 1 year, then we do have a quarterly redemption program available. And so you can participate in that, but you're restricted on that to where you have to be in the fund for 1 year before your shares will be eligible for redemption. And we give priority to death and disability. Quite frankly, nobody has yet actually asked for redemption from any of our shareholders. So I don't think it'd be a problem with anyone actually redeeming when it's time.